Assalamu alaikum, dear student. This is Abeel Ahmed, your financial management teacher and CEO of Abeel School of Accountancy. In the previous class, I did give you a very small homework, and I strongly believe you people have attempted that question. Let's just start from there. This is the question, if I'm not wrong. Total shareholders' return is 20%. Dividend per share is $2. Current share price at the start of the year was 20. And we need to calculate share price at the end of the year. So actually total shareholders return is equal to dividend which is given to us, plus we need capital gain which we don't know right now, so X, and the current share price I need to know at the start of the year which is given to me, it is 20. So shareholders return they have given us in the question, it is 20%, means I can write 0.2. So 2 plus X 20. So simply 0.2 multiplied by 20 is equal to 2 plus X. Basically, this X is representing the capital gain, because we know that in the total return of the shareholder is actually consists of two things. One is dividend, another is capital gain. So if I take 20% of 20, obviously it is 4, if I'm not wrong. So it means the capital gain is 2. So the capital gain is actually 2. Okay, the capital gain is 2, but still it is not the answer. The answer which we need, actually, the requirement is calculate current share price at the end of the year. We can easily calculate current share price at the end of the year. All you need is just take the current share price at the start of the year, which is 20, just add capital gain. So basically the current share price at the end of the year is 22. Because the difference between the current share price at the end of the year and the share price at the start of the year, the difference is actually the capital gain. So what I did, I first computed capital gain, and then we simply added that capital gain to the current share price at the start of the year to get the share price at the end of the year. So actually, I just wanted to give you an idea how do we calculate total shareholders return. And we also discussed in the first class, basically the primary objective of financial management is to maximize the wealth of the shareholders. And the shareholders' wealth will be maximized if the market value of equity will increase. Basically, how do we measure the wealth of shareholders? So I did mention it is universally acceptable. By calculating market value of equity, you can measure the wealth of shareholders. When it comes to total shareholders return, so basically the total shareholder return is consist on two things. One is capital gain and another is dividend. So that was just few basic things relating to, I would say, how do we calculate total shareholders return and the primary objective of financial management we did discuss. In the first class, I also discussed actually the sequence of the syllabus in which we will study this financial management. And we are going to cover each and everything, the theoretical part as well as the numerical part, long as well as MCQs. Just if you want to have a quick, I would say, glance on what you have in the syllabus. So this is what basically part A of the syllabus. Then you have B, C, D, and E is there also, F and G. So don't worry at all, you will get this document in which you have the entire syllabus of financial management. It will really help you a lot, because once you have the entire financial management syllabus in front of you, so while teaching, when you'll be obviously watching lectures, then you can tick that which area you have covered. So okay, now we are actually starting our first important area of the financial management, and which is investment appraisal. So let's just start investment appraisal. And I did mention in the first class, investment appraisal is approximately 40% of your syllabus. If it is 40% of your syllabus, it means that you have to spend a really good amount of time on this topic. Investment appraisal. First of all, before we start investment appraisal, let me write all the techniques, all the name of all the topics which we are going to cover in this investment appraisal topic, because otherwise the misconception is the most of the student, they think that just NPV and IRR, they are in investment appraisal. This is not the case. Basically, how many topics we have in investment appraisal? Number one is NPV. We will start from NPV, inshallah. Second is IRR, internal rate of return. NPV is net present value. Third is ARR, accounting rate of return. Sometimes examiner says the same thing as ROCE, return on capital employed. Payback period. Basically, when it comes to payback period, we have two types of payback period. One is simple payback period. Another is discounted payback period. So we have two types of payback period, simple and discounted. Fifth, we will be studying sensitivity analysis. Six, we have lease or buy decision. Lease or buy decision. We have capital rationing. So basically, if I talk about investment appraisal, we will also study, inshallah, asset replacement decision. Asset replacement decision. So look at this, in investment appraisal, actually NPV is not the only topic which you will study in investment appraisal. We have NPV, net present value, IRR, internal rate of return, accounting rate of return, payback period, in which we have two payback period. One is simple payback, another is discounted payback. Then sensitivity analysis also comes in investment appraisal. Lease or buy decision is also a part of investment appraisal. Capital rationing is also a part of investment appraisal. And finally, asset replacement decisions. It means, inshallah, when we will say that we have completed investment appraisal, then you have to make sure that we have covered all these 8 areas in your investment appraisal. Okay. Now let us start. The first technique in investment appraisal . The first technique we are starting, that is NPV, net present value. Before starting NPV, we need to know few basic things. Then slowly and gradually we'll come to NPV, inshallah. One, when we say investment appraisal, now listen and listen carefully. If there is only single project in front of you, imagine a scenario in which you have a just single project in front of you and your organization needs to make a decision. In case of a single project, the investment appraisal decision is going to be accept or reject. If we have a single project in front of us, how do we make a decision? Simply either we are going to accept that project or reject. But if you have 10 or 20 projects in front of you, and let's say your organization needs to decide which project should we opt, and let's say they just want to opt only one. So then you will be choosing, you will be actually need to choose between all number of projects. It means if we have a single project in front of us, either accept or reject is very simple. If NPV of that project is positive, we will accept. But out of 20 or out of 10 projects, if I have to opt only one, then I'm going to opt the project which gives me the highest NPV. So in case of a single project, if the project gives me positive NPV, I will accept. But in case of more than one projects which are in front of us, an organization needs to opt only one, then we will be opting that project. We will opt that project which gives us the highest NPV. Okay. Now, few basic things relating to investment appraisal you need to know. Number one point is, I'm not right now starting NPV. What is actually net present value? How do we calculate it? What is the meaning of NPV? If the NPV is zero, then what is the interpretation? Do we need to opt or reject? If the NPV is positive, what is the interpretation of that NPV? If NPV is negative, we will come to all. I'm going to tick all the boxes. Don't worry at all. The very basic concept which I'm going to give you right now in financial management, either it is a basic financial management FM or an advanced financial management AFM. The very basic concept is point of investment. The day when you are going to make investment in financial management, the point of investment, time of investment is called year zero. So time zero, or you can say year zero. Actually, this is time of investment. So basically, year zero or time zero means the point of investment. Whenever you are making investment, it could be any month, it could be any day. But the point in financial management, day of investment is considered as time zero. Okay. Now, what are the basic concepts of investment appraisal? What are the rules of investment appraisal? What are the principles of investment appraisal? How do we apply all those rules on NPV? We will discuss that. Don't worry at all, inshallah. But right now, I just want to discuss few basic things. Then slowly and gradually, we'll be discussing what are the principles of calculating NPV. But before going to the principle, before discussing the principle, let me just discuss few basic things. Number one concept, whenever you are making an investment, obviously, initially, there will be an outflow of cash because you are making an investment. Then slowly and gradually, you will be getting inflows as well. So just try to visualize you are making an investment. So obviously, the first there will be an outflow, then there will be a combination of inflows and outflows. But first, you have to make an investment. For example, let's say we have a project in front of us which has useful life only 3 years. T1, T2, T3. T0, as we discussed right now, actually T0 is point of investment. Okay. I'm just assuming the initial investment is $1,000. Okay. Sales. Let's say sales we have 2,000, we have 6,000, we have 8,000. Assuming variable cost is 20%, 25% of sales. If the variable cost is 25% of sales, if I take 25% of 2,500, 25% of 6,000 is 1,500, and 25% of 8,000 is 2,000. Let's assume we have only these cash flows. That's it. We have initial investment, we have sales, we have variable costs. That's it. Okay. Let's do the net of net cash flows. 1,000 negative 1,500, 4,500, and 6,000. Okay. Now there's a very interesting point. Now listen and listen carefully. You have net cash flows in front of you. At time zero, there's an outflow of 1,000. At T1, there's an inflow 15, net inflow 1,500. T2, we are having an inflow of 4,500, and T3, we are having a net inflow of 6,000. Now the issue is, you cannot directly add the cash flows of T1, T2, T3, and deduct 1,000 and make the decision that should we opt this project or not. Why we cannot directly add all these T1, T2, T3 cash flows and net off with 1,000 investment? There's a reason. The reason is, logically, the cash flow which is coming in T1, it is a future cash flow. 4,500 will come after 2 years. 6,000 will come after 3 years. So logically, the net cash flow at T1, T2, T3, all these three cash flows are future cash flows. And time 0, the outflow 1,000 is in its present value terms. So logically, I cannot net off future cash flows and cash outflow at time 0, which is representing the present value. So logically, you have to do one thing. We have to convert the future cash flows to the present values. How do we convert the future cash flows to present value? The name of the technique is discounting. Through discounting, what do we do? So simply discounting is a name of technique which converts future cash flows to present cash flows. Discounting is a name of technique which converts future values to present values. Repeat, discounting is a name of technique which converts future value to the present value. Now the question is, how do we do the discounting? But before doing the discounting, let me explain again. Discounting is a name of technique which converts future value to the present value. Okay. Now, how do we do the discounting? Basically, for doing discounting, you need to have a discount factor. Another name for the discount rate is cost of capital. Assuming the cost of capital is 10%. Assuming the cost of capital is 10%. And let me tell you, once we'll discuss all these basic things, and then slowly and gradually we'll go to the Excel and we'll be solving all, majority of the question we'll be solving on the spreadsheet. And I'll be discussing all those shortcut formulae which are given to you in FM, in financial management. Because if I'm discussing a shortcut which is not in your financial management syllabus, then it is useless. So that is why I'll be discussing all those formulae, all those shortcuts which are in financial management syllabus. But right now we are learning, so I'm not going towards any formula right now. Assuming the cost of capital is 10%, at time 0, the discount factor is 1. At time T1, it is 0.909, then 0.826, and 0.751. How do we calculate these discount factor? I'll tell you this also, don't worry at all. Now, very easily, we can calculate the present value. All you need is just multiply the future cash flows with the discount factor. When you multiply the future cash flows with the discount factor, it gives you the present value. When you multiply future cash flows, when you multiply, just a minute. When you multiply future cash flows with the discount factor, you will get the present values. So present value of net cash flows. Simply, this is 1,000 negative. I am just using my calculator. 1,500 into 0.909. I'm getting 1,363.5. Let's make it 1,364. And please do not worry about the rounding off. Okay. 4,500 into 0.826. 3,717. 3,717. Just a minute. I don't know what is the issue. Okay, now it is fine. So 6,000 into 0.751. I'm getting 4,506. Okay, now you can do the net of NPV, net present value. Actually, we have, through discounting, we have converted future values to the present values. We have converted future values to the present value by discounting. Now simply add all these three values: 1,364, 3,717, and 4,506. Let's see what I'm getting. So I have a 1000 negative plus 9587. Let me recheck. So we should not be making any mathematical error. So it means the final answer is positive 8587. Since the NPV of this project is positive, that is why we are going to accept this project. Actually, the positive NPV shows that wealth of shareholder will increase. Because this positive NPV means, look at the data. While reaching at positive net present value of 8587, what we have done? We have deducted the initial investment. We have also deducted the variable cost. We have also done one more thing. We have also converted future values to the present values. So it means I can say one thing. After recovering each and every cost, after converting future value to the present values, and after doing net off, we are still getting something. So actually this positive NPV means after recovering each and every cost, is still something will left for the company. So that amount is 8587, which shows that positive NPV shows that this project is financially viable. This is a beneficial project, and organizations should opt this project because it will increase the wealth of shareholders. Now the question arises, why did I mention the wealth of the shareholders will increase? Because the primary objective of financial management is to increase the wealth of shareholders. So simply, whenever the positive NPV comes, organizations should opt that project on financial grounds, obviously, because it will increase the wealth of shareholders. Now let's question. So what if the project had a negative NPV? Then we would have rejected the project, because negative NPV means this project is a loss-making project. This project cannot recover each and every cost. So that is why loss-making projects should be rejected. Otherwise, loss-making project will decrease the wealth of shareholders. Let's see another example, I would say, rather than a question. T0, T1, T2, T3, and let's take T4 this time also. Initial investment, just an example. Assuming the initial investment is 50,000, we know that initial investment comes at time 0. Now let's talk about the cash flows. Sales, I'm assuming the sale is 40,000. Then I have a sale of 50, 60, and let's make it 65. Okay. Variable cost is, let's say, 30% of sales. Again, I'm assuming all this data. It is 12,000, 15, 18, and this will be 19,500. Let's say this time you have a fixed cost also. And obviously the relevant fixed cost comes in NPV questions. And what do you mean by relevant fixed cost? We'll discuss that. Don't worry at all. Because when it comes to variable cost is always relevant. When the fixed cost is relevant, when fixed cost is not relevant, we will discuss, because right now we have not started the principles of NPV. We will discuss, inshallah, principles of NPV. Don't worry at all. Right now, whatever fixed cost I'm taking in this example, all fixed cost is relevant. Let's say in the first year it is 10,000. Again, it is 10. It is 15. And let's say it is 15. Assuming we don't have any other cash flows. Let's see, net cash flows 50,000. So 40 minus 12 minus 10 gives me 18,000. 50,000 minus 15 minus 10, 25. 60 minus 18,000 minus 15, it is 27,000. 65,000, 19,500 minus 15,000. 30,500. Again, we cannot simply add all T1, T2, T3, T4 cash flows because all T1, T2, T3, T4 cash flows, they are future values. We need to convert them to the present values by discounting. Assuming the cost of capital is 10%, cost of capital is 10%. So 1.909, 0.826, 0.751, and 0.683. How do we calculate these discount factor? I'll be discussing right now, just within 2 to 3 minutes after completing this question, inshallah. Present value of net cash flows. Obviously, it is 50,000. So 18,000 to 0.909, 16,362, 25,000 to 0.826, 20,650, 27,000 0.751. We are having 20,000, 277, 30,500 into 0.683. We are having 20,831.5. You can make it 32, no issue at all. 20,832. Now we can easily calculate NPV, net present value. 20,832 plus 20,277 plus 20,650 plus 16,362 minus 50,000. I'm getting positive 28,121. So what I did, I added all the present values, 1, 2, 3, and 4, and then just deducted 50,000. So let me recheck so that there should not be an issue. 16,362 plus 20,650 plus 20,277 plus 20,832 minus 50. Yes. Again, NPV of this project is positive. Whenever NPV positive comes, organization should opt that project because it will increase the wealth of shareholders. So since NPV of this project is positive 28,121, which will increase the wealth of shareholders. Therefore, organization should opt this project. Since NPV of this project is positive, and we know that positive NPV actually increases the wealth of the shareholders. That is why this project should be opted. So actually in these first two examples, I just wanted to give you the little bit basic idea of how do we calculate this NPV. Now let us discuss basic principles of calculating NPV. Because right now in question 1 and 2, we did not discuss any principles. We just solved 1 and 2. Now the time has come that we start discussing the basic principles of NPV. Basic principles of NPV. Basic principles of net present value. What are the basic principles? First point, a very first point. Only relevant cash flows are considered. Basic principles of NPV. Only relevant cash flows are considered. Only relevant cash flows. That's very, very important. Which cash flows? Only relevant cash flows will be considered. Now let us discuss what do you mean by relevant cash flows. Now the entire discussion is only on one concept right now, that is relevant cash flows. What do you mean by relevant cash flows? And we'll be discussing, don't worry at all, after a few concepts. What is the difference between cash flow and accounting profit? We will discuss that also, don't worry at all. But right now, let us only discuss what do you mean by relevant cash flows. Okay. Now everything revolves around relevant cash flows. You can say this is principle A, relevant cash flows. Future cost is relevant. Which cost? Future cost is relevant. Now, what do you mean by future cost? Basically, the initial investment which you people have seen in example 1 and 2, that's a future cost. Actually, organization has not incurred that investment because you calculate NPV before making an investment. Because after making an investment, what is the point? So actually, that initial investment has not actually occurred. So that initial investment is logically your future cash flow. And that's your future cost. Even the variable cost which you have seen, that's your future cost. Even the fixed cost which you have seen in the second example, that was your future cost. So simply, future cost is relevant. Future cost means the cost which is still to be incurred, yet to be incurred. You have not incurred that cost. Similarly, future cost is relevant. Similarly, future benefits, future inflows are relevant. Like we have seen in example 1 and 2, there was a sales. Obviously, the sale which relates to the project, the sale which is arising from that project, that is obviously relevant. So future cost is relevant. The cost which will be incurred in the future. So future cost is relevant. Slash, you can say cost is still to be incurred. Another thing, you can say that, okay, we'll come to this. Okay, cost that is still to be incurred. When we are saying that future cost is relevant, the cost is still to be incurred is relevant. Another very important concept, you can say that future benefits are relevant, means the future inflows which are relating to the project, cash inflows associated with the project, they are relevant. So benefits to be earned are relevant. Simply, cash inflows associated with the project, they are relevant. Now let's make more specific concepts. Now let's discuss more specific, because when you say future cost is relevant, the cost still to be incurred is relevant. Okay, benefits to be earned in the future, they are relevant. Simply cash inflows associated with the project, they are relevant. Now a very important concept comes. Either it is a cash outflow or the cash inflow. It must be caused by the project. So it could be inflow, it could be outflow, but it has to be because of the project. If it is because of the project, then it is relevant. So third important concept, the rule is caused by the project. For example, we are talking about incremental cash flows. Incremental cash flows. For example, incremental cash flows. For example, opportunity cost. Obviously, because of the project, if you are bearing any opportunity cost, that is relevant for you. So third concept, the rule, basic rule is very, very important. It's critical, that caused by the project. So either it is inflow, outflow, whatever it is, it has to be because of the project. If it is caused by the project, then obviously it is relevant. It is relevant. Okay. Now, another important concept relating to the relevant is, what is that? That is by definition, by definition, by definition. By definition, must be a cash flow, must be a cash flow, except tax depreciation. Another name for the tax depreciation is capital allowance. Another name for the tax depreciation is capital allowance. Now listen and listen carefully. When you are calculating NPV, so please, dear student, try to understand one thing. Whatever inflow or outflow comes and you're taking the either inflow or outflow in the project, make sure it has to be cash flow. So the basic principle 4 says, concept number 4 says, by definition must be a cash flow except the tax depreciation. Now listen and listen carefully. Tax depreciation, another name for the tax depreciation is capital allowance. Tax depreciation itself is not a cash outflow. Tax depreciation itself is not a cash outflow, but what happens? Tax depreciation actually reduces your taxable profits. It actually reduces your taxation. It actually results in tax savings. So since tax depreciation itself is not a cash outflow, but what happens due to tax depreciation, organizations, they save tax. That is why we incorporate tax depreciation in NPV. But the way we incorporate the tax depreciation, another name is capital allowance, into NPV, the whole objective is to show only one thing, tax saving from that tax depreciation. That's it. It means that if someone has, let's say, already computed the NPV, and that individual is not taking the, let's say, tax appreciation into its calculation by saying this, since it's a non-cash flow item, that's why I did not consider it. So this argument is not acceptable, because even though tax depreciation itself is not a cash outflow, but what happens, tax depreciation actually results in tax saving. That is why you have to consider your tax depreciation in NPV. How do we consider? We will discuss that. Don't worry at all. But the way back, one question in financial management came on this concept for 2 marks. The question was, someone has already calculated NPV by ignoring tax appreciation. The argument that individual gave, it was, since it's a non-cash item, that's why I did not consider. So the counter argument which you were required to write, that it was, since tax appreciation itself, it's not a cash outflow, but it saves taxation. That is why it has to be considered. Now the point number 5. Since a very first concept which we discussed relating to the relevant cash flow, we said future cost is relevant. It means the past cost is irrelevant. It's very simple. When you are saying future cost is relevant, which cost? Future cost. If future cost is relevant, then it's very simple. Past cost is irrelevant, because whatever happened in the past, it has happened. You cannot revert it back. So just I'm taking 1 minute on this. When we say whatever happened in the past, it has happened. You cannot bring it back. So some of the people, what do they do in their life? Actually, they live their life in the past. All the time, they just keep thinking what has happened in the past with them. They just keep thinking in that. Never do that. Living in the past will not help you to become successful. Living in the past will not help you to become successful. Living in the past can destroy you internally. Living in the past will keep you far, far away from the success. So whatever happened in the past, it has happened with, it could be anyone. So make sure one thing which is in your control, that is present. You need to work hard in the present in order to make your future bright. That's it. That's what I really want to say. So the cost which has happened, which has incurred in the past, it is irrelevant. The past cost is irrelevant. Past cost is irrelevant. The name for the past cost is sunk cost. So sunk cost is irrelevant. For example, before making an investment in a project, your organization has conducted research and development, R&D. But before making an investment, let's say your organization has conducted a research. On that detailed research, let's say you have incurred millions of dollars. Even though you have incurred millions of dollars, but that millions of dollars is irrelevant, because you have carried out the research in the past. So right now you make an investment or not, it will have no impact on the cost which you have already incurred in the past. So that is why we say past cost is irrelevant. And I'm really, really surprised that, mashallah, you are a potential chartered accountant, me myself a chartered accountant, and we know very well this concept of sunk cost, past cost, and we do believe that past cost is irrelevant. Obviously, in NPV question, if you take the past cost as irrelevant cost, you will be losing marks. You know that, I know that. And obviously, you're not going to make that mistake in your exam. You're not going to make that mistake even while solving the practice question. You will never consider a past cost as a relevant cost. And you believe that doing this is wrong, this is incorrect. But the surprise part to me is when it comes to your own future decisions, most of the time I've seen the student, they consider the past cost as relevant when they are making their own decisions. For example, if I ask a student, do one thing, let's say learn that soft skills and make little bit more investment on your education, then there are number of students, they say that, sir, we have already incurred such a heavy cost in the past, so you want us to make more investment. So as soon as when the student says, I have incurred so much in the past and teacher wants us to make more investment, so what that student is making a mistake, he's considering that past cost as relevant. So obviously right now whatever decision he's going to make, he is going to make a wrong decision, because past cost is irrelevant. So that is why even when you are making your own decisions relating your life, never take the past cost as relevant. Do not live in your past. You have one thing, that is present. Work hard in the present in order to make your future bright. That's it. So past cost, the example is sunk cost is irrelevant. Another thing, fixed committed cost is irrelevant. Fixed committed cost is irrelevant. Now, what do you mean by fixed committed cost? For example, the business premises which is already on rent. Try to understand. Assuming your organization is having a business premises which is already on rent, and you have already accommodated one project in that premises. Let's assume that premises is so big, so spacious, that you can easily bring one more project into the same premises. Now listen and listen carefully. When you are bringing a new project into the same premises, let's say that premises can accommodate another project. So when you are bringing another project to the same premises, so the rent which you are already given, the rent which you are already giving is not a relevant cost for the new project, because either you are accommodating the new project or not, either you are making an investment to the new project or not, you have to give the rent. And let's say we are doing investment appraisal on that new project, so the committed fixed cost is irrelevant for the new project, because you have not taken the premises on rent for the new project. So since you have to incur that fixed committed cost, either the new project is accommodated to the same business premises or not, that is why that rental payment is irrelevant. So committed fixed cost, even though you will be making that committed fixed cost will be incurred in the present as well as in the future, but still it is irrelevant because you have made the commitment in the past and you have to incur the cost in the present as well as in the future. So simply committed fixed cost, let me explain again, is irrelevant. The example of the committed fixed cost is, for example, a business premises which is already on rent. So whatever rent you are paying, it will not be relevant for the new project. So committed fixed cost is irrelevant. For example, rental payments. For example, rental payments, but relating to the business premises which is already on rent. Let me repeat that. For example, rental payments relating to the business premises which is already on rent. 7. Basically, interest payment and dividend payments are irrelevant. The question is why interest payment and dividend payments are irrelevant? Because interest payment and dividend payments, they represents payments to the provider of finance, and payments to the provider of finance impact is already considered in cost of capital. So it means you have already considered the impact of dividend payment and interest payment to the cost of capital. If you're considering those cash flows of dividend payment and interest payment as relevant cash flows in NPV, then there will be a double impact. One, you have already considered in cost of capital, and second, you are taking same cash flows into NPV also. That is why it will be considered as double counting. So that is why we say while calculating NPV, never take financing cash flows, that is interest payment and dividend payments. Reason, because their impact is already incorporated, their effect is already incorporated to the cost of capital. How do we incorporate the impact of dividend and interest payment to the cost of capital? Inshallah, you will study that and you will see with your eyes, inshallah, when we will be studying, inshallah, cost of capital. So simply interest payment and dividend payments. Already effects of interest payment, dividend payment effects is already incorporated to cost of capital. That is why do not take financing cash flows relevant while calculating NPV. Okay. Another thing, your existing fixed cost is irrelevant. Your existing fixed overheads are irrelevant, because why existing fixed overheads are irrelevant? Because existing fixed overheads are not incremental cash flows. Repeat, Existing fixed overheads are irrelevant because why they are irrelevant? The reason is because they are not incremental. So existing fixed overheads are irrelevant. Why relevant? Let me repeat, because they are not incremental cash flows. Now, there's a very important concept, dear student. Listen. For existing fixed overheads, in financial management, examiner can use different terminologies. So you should not be, we should not be expecting from the examiner that he's going to mention the word existing fixed overhead. So there are a few technical terms, you can say jargons for existing fixed overheads. So if you come across any one of them, so please take them as irrelevant because all those terms which I'm going to discuss right now means existing fixed overheads. And as I mentioned right now, why existing fixed overheads are irrelevant? Because they are not incremental. So terminologies which can be used with existing fixed overheads. A, examiner can use the word allocated overheads. Allocated overheads. B, examiner can use apportion overheads. Apportion overheads. Third, examiner can use the word applied overheads. Okay. Examiner can use the word absorbed overheads. Even examiner can use the word ABC allocation, activity-based costing allocation. Actually, the difference between absorption costing and ABC costing is only one. In absorption costing, actually we have an objection. The objection on absorption costing is they basically do unfair allocation of overheads. Because absorption costing, they have just two bases normally to allocate the overheads. One is labor hour, another is most of the time the machine hours. So the difference between ABC costing and absorption costing is under ABC costing, we claim that overheads allocation will be fair. But in absorption costing, allocation of overhead is unfair. Now listen, either it is absorption costing or ABC costing. In both the costing, total overheads will be same. Only the difference is in allocation. So since absorption costing is working on existing overheads, ABC costing is working on existing overheads, only the difference in allocation. So that is why we say either examiner is using ABC costing or absorption costing, they are irrelevant for us. So now, dear student, for existing overheads, your examiner can use any one terms out of these five. But whatever they come, it is always irrelevant. Okay. Now, now you should be having a really good idea about little bit, not too much, but little bit idea about, I would say, relevant cost. Now, let us discuss the relevant cost relating to labor. Relevant cost relating to labor. And then slowly and gradually we'll start, inshallah, more principles. Relevant cost relating to labor. In financial management, you should be expecting hardly, I would say, one multiple choice question, which I've seen in the kit, which they have asked on the relevant cost of the labor. Otherwise, normally in NPB questions, examiner does not go in too much detail of relevant costing relating to labor. But since examiner also examines the multiple choice question, and in the past they have asked at least one or two MCQs on relevant costing relating to labor. That is why we are discussing this part, because I'll try my best not to leave even a single, I would say, stone unturned. We'll turn all the stone. Even there is no stone, still we'll try to turn it. Okay. Relevant cost to labor, I'll be a bit quick. Number one, if your labor is having an idle time, and it means the relevant cost is 0. Labor is idle. Labor is idle. So relevant cost is 0. Okay. For example, your existing labor is working at full capacity. Okay. And assuming your existing labor is working at full capacity, okay, and just assume that in order to opt that project, you want your existing labor to work on the new project. But if your existing labor is going to work for the new project, then existing work will be stopped and there will be a contribution loss, since your existing labor is at full capacity and that labor is so specialized, so skilled that he cannot replaced. Opting new project means you will be sending your labor, your existing labor who is at full capacity, they will be working on the new project, and you will be losing there will be a contribution loss on the existing project. In that case, what will be the labor cost? When labor is at full capacity and cannot be replaced, then relevant cost is equal to whatever we are making payment to the labor plus the contribution loss. Payment to labor, payment to the labor plus contribution loss. Okay. Third, there's a possibility that you're opting a new project and your existing labor is going to work on the new project. But for existing contract, you are going to bring a replacement labor. A very important concept. Whenever a replacement labor comes, the cost of replacement labor is always relevant. So a replacement labor cost is always relevant. Either you are paying more or not, that is not an issue. Replacement labor cost is always relevant, because the new replacement labor comes only because of the new project. So replacement labor cost is always relevant. Another final concept, if to do the same job, number of alternatives are available, then always, according to the relevant costing, always opt the cheaper one. Assuming you want to do work Y, to do work Y, you have labor A as well as labor B, both are available, then obviously I'm going to opt the labor who charges me the lower amount, assuming the quality, each and everything is same. So simply, to do the same job, to do the same work, when number of alternatives are available, number of alternatives are available, then choose the one which has a lower cost. Okay, dear student, that is all about relevant costing relating to financial management. Obviously, there are many cases relating to relevant cost of material and all that stuff that is not examinable in financial management. So we'll stick to the area which is actually examinable in financial management. So we have discussed the first rule relating to the relevant costing. Now let's go to another rule. Another rule is, then you can see another basic principle is, that was all about A. Now we're discussing B. Cash flows. Actually, the basic principle second which we're discussing, that is cash flows. Actually, we have two types of cash flows. One is real cash flow. Another is nominal cash flow. I'm just giving you a few ideas, then we'll start the new lecture from this point, inshallah. Actually, there are two types of cash flows. One is real cash flows without inflation. Second is nominal cash flows with inflation. For discounting the real cash flows, you need to have a real cost of capital. For discounting the nominal cash flows, you need to have a nominal cost of capital. How do we convert real cash flows to the nominal cash flows, and how do we convert real cost of capital to the nominal to the real, and how do we convert nominal cash flows to the real cash flows? All these things, inshallah, we will discuss in the coming lecture. So the coming lecture will start from the cash flows, in which we will learn how do we convert real cash flows to the nominal cash flows, and we will also discuss when do we need to convert, and how do we convert real cost of capital to the nominal or nominal to the real. All these things will be discussed, inshallah, in the next class. And from the next class, inshallah, we'll start properly discussing NPB questions. And I'll try my best to have each lecture will be approximately, I would say, 45 minutes long, approximately. Could be sometime 50 minutes, could be sometime 40, 35 minutes, but average is going to be 45 minutes. Because having too long, I would say, financial management lectures, they are not beneficial. That is my own experience. Student, I don't think so. In one go, student is not going to give 2 hours to the screen. So screen time should be minimum. So that is why in my lectures, you will find on average time period will be around 45 minutes. Like in the first lecture was hardly, I would say, 20 minutes long. This could be around 50 to 45 minutes long. So on average, each lecture will be 45-minute long. Don't worry at all. So thank you very much for watching this lecture. And I always say, have a nice life.